Good morning and welcome this morning to Trading Index Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out there in the chat by my good friend Cameron May, 20-plus year veteran of the financial markets. He is there to help answer your questions. Thanks to all of you for being here, whether you're here in the live version or the recorded version. We're glad to have you with us. Participate in the conversation. If you're here in the live version, go ahead and chat in questions. Cameron's there to help out. I'll keep an eye on those as well. If you're watching this after the fact, after this gets posted as an archive, then leave your comment in the comment section and we'll get to that as well as quickly as we can so you can participate in the conversation as well. Now, boy, there is a lot of stuff going on today with indexes. And so we're going to take a look at a couple of positions that we've already been managing. We're also going to see maybe what's happening with a possible rotation out of some of the technology heavy names and into some of the technology names in the small cap index. And we'll see what that maybe has in store. And we'll look at those charts and maybe look at some examples as we get into this discussion. But a couple of quick housekeeping items before we get started today. Remember that everything we talk about is simply for illustrative and educational purposes only. It is not any kind of a recommendation or advice. Remember that investing involves risk, including the loss of principal. Remember that past performance is no guarantee of future results. Now, equity and index options, they do carry a high level of risk. They are not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy. Remember, as we talk about multiple leg option strategies will entail multiple transaction costs. And spread trading generally has to be done in a margin account. Now, the options that we're going to be focusing on, the index options that we're going to be talking about, are in this discussion all going to be European style options, which means that those options cannot be exercised prior to expiration, which means if you are short those options, you theoretically cannot experience, because nothing is absolute. Strange things can happen, but theoretically cannot experience early assignment like you can with an American style option. So just be aware of that. That's one of the reasons why we talk about using index options as a tradable instrument. So we're going to talk about that. We're going to talk about those characteristics. We're also going to use the Thinkorswim desktop software platform for this discussion. Remember that the Thinkorswim desktop software platform, especially the paper money version, not a guarantee of future success out there in the real world. It is, however, a great learning environment. Make sure that you are aware that there are some differences between paper money and live trading. And as you get into that, move your practice from paper to live, make sure that you're aware of those differences. Now, we're going to be using technical analysis in this discussion today as well. Technical analysis is only one way to look at the market. It is theoretical in nature. It does not a guarantee of the future. And from that standpoint, Schwab doesn't recommend the use of technical analysis as a sole means of investment research. So let's do this. Let's pop into the Thinkorswim desktop software platform here really quick, and I'm just going to take a look really quick at what's going on in the major indexes. And so I'm going to jump in and I'm taking a look at the SPX here, the broad market. Now, not a measure of the whole market, but a broad cross section. And as we talk about this, one of the things that I happen to notice is this kind of waffling this morning as this index kind of toggles back and forth between green and red. A little bit of upward movement today. We see a little bit of a high on that candle. But this has been really indicative, I think, overall of what the market has been doing over the course of the last couple of weeks. We've not seen a lot of momentum in this market. In fact, we've seen this market really kind of go sideways and trend sideways. You can see what's changed. You see the week to date plus 0.45, the month plus 1.95, the year plus 0.7, or excuse me, 7%. So as you look at those differences, you can see that it's kind of slowing down. It's kind of going sideways, even if you can't see from the candlesticks for this particular case. The RSI ticking a little bit higher here. So maybe we've got a little bit of a bullish push going on with sentiment, but RSI is going to lag, as all oscillating indicators do. So what's more important, I think, realistically, is price action. You've got the 50 and the 200 that are both moving higher. So there's some bullishness to the index, just not right now today in this particular candle. It's kind of waffling around and giving us a bit of a mixed bag, as is typical of summertime, right? And this is a typical summertime market pattern. Again, news can change that, and news can change that instantaneously, and we know that. So it doesn't guarantee by any means. The fact that it's summer does not guarantee that the market is going to continue to move sideways. Take a look at the NASDAQ, though. This is maybe where there's a little bit of a disparity between what's going on with the SPX, the broad market, where there has been that technology leadership as well here in the NASDAQ. We see that the NASDAQ perennially and over the course of the last couple of weeks has been stronger. Month to date, it's been stronger. Year to date, it's been stronger than the SPX. Week to date, on the other hand, we're starting to see maybe, again, with today's downward move, and I'm going to zoom in here a little bit, maybe a little bit of rotation. So that's a typical pattern, right? We talk about the idea of building a balanced portfolio, and we talk about the idea of using kind of sector analysis and seeing where rotation is happening. And this is kind of sector analysis kind of writ a little bit larger because, you know, if this technology sector, the technology sector that's generally been leading the NASDAQ, which is, you know, the tech heavy type of index primarily, it's not entirely technology, but it is primarily technology. If those have been the leading stocks and investors are rotating out of some of those leaders to find new opportunities, then this is exactly the scenario that may present itself, where you start to see the NASDAQ rolling over a little bit, and then you see other indexes like the small cap index, for instance, turning a little bit higher. So here's the NASDAQ. This is the big index. This is the NASDAQ 100, but starting to see that kind of rolling down a little bit. Not hugely and not breaking down to levels of support, but just kind of rolling over a little bit. And then you notice what's going on with the RSI. If we were to draw a line on the RSI and we were to follow those lows over the last couple of days, you can see that those lows were getting higher, and now it's starting to turn down. And you've in fact got the RSI line pointed down slightly as an indication that maybe there is a bit of momentum slowing. Not radical change by any means, but at least a little bit of a slowing at this point. And if we look over here at the Russell 2000, something interesting appears to be happening. Notice the change here. Year to date, the weakest of the three indexes. Month to date, the strongest of the three. Week to date, the strongest of the three. Right? So as we start to see this breakout, a little bit of a rotation here, RSI ticking up, not up into extreme, which means that it's not in an overbought state. And we see that the 50-period moving average in this case is accelerating to the upside. 200-period not yet turning higher. So overall not breaking out, but this rotation, I think, is potentially occurring. And that, I think, presents two possibilities here, or two kind of scenarios. One is that, you know, this is just simply rotation into an area that has not seen a lot of attention recently from buyers, number one. Number two, this might be in anticipation of what could potentially happen next week with the Federal Reserve meeting, with the possibility of an interest rate cut. Now, obviously, there's a lot of political pressure. There's potentially some economic pressure to see those cuts, but the Fed is the Fed, and the Fed's going to do what the Fed's going to do. So this might be supposition that the Fed reduces interest rates, which would be theoretically beneficial to the small caps. And so this might be an anticipation of that. Regardless, we don't know, right? I have no idea why, other than anecdotally and other than kind of circumstantially, why the Russell is starting to advance and the NASDAQ is starting to pull back. But we can certainly take advantage of that possibility, right? And Carol, I love it. I love the excitement about the VIX going below the 16 handle. Let's pop onto the VIX index. and take a look at that here really quickly, because that is really something to pay attention to, right? The fact that the VIX is still bleeding lower. It's in the 15 handle now. It's 15.91. Now, we could make the argument that maybe there would be a little more excitement from an options trading perspective if the volatility index, the VIX, were higher, because more volatility brings more premium, more volatility brings more movement, more volatility brings perhaps more opportunity, right? So from that perspective, a lower VIX is representative of maybe that slow market, right? We talked about that summertime market, the VIX kind of grinding lower. We've seen periods of time when the VIX grinds lower like this. You've also seen periods of time when the VIX explodes, right? I mean, we can just zoom back out on this chart and see some of those times on this chart, right? The April lows in the market took this VIX back up and notched the 60 handle, but starting to pull back a little bit here and bleeding off. Thus is the nature of the VIX, right? The volatility index. So if VIX is falling or VIX is low, I just want to say this, right? When VIX is low, there used to be this whole phrase, and Cameron remembers this, and some of you who've been around us as educators on the coaching team for a long time, you might remember this phrase that we used to use. Although I think the underlying comments behind it have perhaps changed a little bit. But it used to be this phrase that we would say, when the VIX is low, it's time to go. When the VIX is high, it's time to buy. And that was the phrase that we talked about. Now, I don't necessarily subscribe to that. Carol's got it. Yeah, when the VIX is high, it's time to buy, because the expectation is that there is that kind of move to the downside. And when the market has been moving up and the VIX is very low, there's the potential for the VIX to explode and go higher. I like to look at it simply from this standpoint, that the VIX is basically a mean reverting instrument, right? If this is the baseline, right, if that's the average and VIX is low, it tends to rise. And if VIX is high, it tends to fall, right? It tends to revert back to the mean. And so I think that's kind of where we are. When this VIX gets down in these lower regions, it has, I think, perhaps a greater tendency to see a little bit of a pop. And again, popping on exogenous news is exactly what the VIX responds to, right? Because if you remember what drives the VIX, right, the volatility index is based on the average prices of options on the SPX index across a cross section of in the money, at the money, and out of the money options across a 30-day time period average, right? So if investors, institutional investors, retail investors, are buying protection either beforehand or after the fact, the volatility index, the VIX, is going to go up. If oftentimes those institutional investors, those retail investors that are buying protection or speculating, right, are doing that in response to some type of event. They oftentimes, we've talked about it in this class a number of times, that institutional investors don't typically tend to be prudent when it comes to buying umbrellas when it's not raining. They tend to buy their umbrellas after it starts raining, when those umbrellas become expensive, and then it makes them even more expensive. That's why you see these big spikes in the VIX. So when the VIX is low, it has a tendency to rise. That's kind of the nature of that. And it doesn't tend to stay high very long. The reason I'm spending so much time on this is because I want to kind of get to this idea of using low implied volatility in selecting an option strategy. Because my thought process in this discussion is, where are some strategies that we could use that would benefit from slightly downward movement and a slight elevation of implied volatility, that would also take advantage of the nature of index options to, or at least European style index options, to not have early assignment risk. And my thought then became calendar spread, because a calendar spread has early, if you're using American style options, has early assignment risk because you're short on option and you're long on option, but it also benefits from a rise in implied volatility. So I wanted to explore this idea of using a calendar spread to take advantage of the circumstances that we're in at the moment. This isn't, look, this particular class, and we've talked about this before, this particular class and other webcasts, this isn't just about teaching the strategy. This is about teaching you how to apply the strategy in the current market conditions. That's the reason why we teach over 30 hours a week of live webcasts, and why we don't just sit in the studio and pre-record all of these and just give you static videos. This is why we talk about live markets, and the reason, not as recommendations and not as suggestions of what you should do, but as examples, illustrative educational examples of what's going on in the real world at the moment and how traders might take the things that they learn and apply them. So my thought then was, if implied volatility is low and we were to look at something like, let's go to our single grid here. Let's take a look at SPX, or we could use XSP. NDX. That's the one that I want to look at, because that's starting to rotate down a little bit. Notice where implied volatility is. So this is the NDX. This is what we looked at on that other index grid with the moving averages and stuff. And this is what we've been using in a couple of the cases. I think we've put some trades on here. I'm going to remove a couple of these drawings here so that it's a little bit cleaner. But I'm going to zoom in a little more closely, and you notice what's happening here. Again, there's that rotation perhaps to the downside. Implied volatility is still staying a little bit lower. But if this were to continue to make that move to the downside, let's say it were to come down to, the 22,880 level or so, where that perhaps previous resistance, old support, or old resistance, potentially new support could be. What's likely to happen to implied volatility here on the NDX is that that implied volatility is likely to rise a little bit. Let's see why that might be important. So I'm going to go to the trade tab here, and the move that I'm looking for in this index isn't huge. It is simply a move right back down to an area where this has been before, right around that 22. We'll call it even 22.8. I'm going to call it 22.850, right? I'm going to kind of round a little bit here. Traders like to round usually. So what I'm going to do is I'm going to go to the trade tab, and we're going to pull up these options. Now, the calendar spread function, the calendar spread strategy, for those of you who have not traded calendar spreads before, is this. We're going to sell a short-dated option, and we're going to buy a long-dated option, but at the same strike price, right? So we're going to sell and we're going to buy at the same strike price. That means we've got an obligation at the short strike and we've got a right at the long strike, but that right and obligation exist at the same price. The difference is the time element of the trade and the sensitivity to implied volatility. Because remember, and going back to our discussion of the VIX and going back to our discussion of implied volatility, I'm going to kind of bring this into the mix. One of the things that we've talked about before, right, is the relationship of time decay or theta sensitivity to proximity to expiration, right? We've talked about the idea that an at-the-money option has a curve that looks like this, and out-of-the-money option has a curve that looks like this. That's time decay. That's theta sensitivity, right? But when we talk about volatility sensitivity or Vega sensitivity, the curve gets a little bit different. Typically, what we see happening with the curve, if this is option premium and this is expiration and duration to go until expiration, what typically tends to happen is much like that out-of-the-money option pattern, where that sensitivity is higher the further out we are, and it gets lower the closer we get to expiration. So and this is really kind of across the board. This doesn't necessarily matter as much whether we're in the money, at the money, or out of the money. So this is Vega sensitivity as we get close to expiration, right? So my thought process is, again, the fact that we can't be assigned early, and we take out that early assignment risk, and we take advantage of a strategy that benefits from low and rising implied volatility. And if we see downward movement in the index, that puts us in a position where that implied volatility might rise. And we look at taking advantage of the disparity or the dispersion date to date or expiration to expiration between the short leg and the long leg. Now we're putting, again, as many factors as we can potentially do it to work in our favor here in this particular case. So let me clear that, and we'll kind of put one of these trades together and see if this works. I wanted to and thank you for going on kind of a little exploratory journey here with me. So what I want to do is I want to look and see where in this expiration cycle I've got a little bit of implied volatility. I want to see a little bit of higher implied volatility simply because I want the short leg to be a little bit higher. And so I'm going to look at this one that is about 2 days to go until expiration. So this is going to be a fairly short calendar spread. Now, normally, if we were looking at selling or creating a long calendar spread, say, for instance, a long put calendar spread, close to expiration and close to the at-the-money position on an equity, early assignment risk is one of those potential risks that we've got to deal with. But this is an European style option, so we don't have that hanging over our heads in this particular case. So I'm going to go to this one that is 2 days to go until expiration. And again, I'm going to be thinking about where this index might move to, right? And so this is much like a long vertical spread in that we're selling where we think it's going to go, right? Not where it is currently. We're selling where we think it's going to go. So we went back to the chart. Let's just kind of double check where we were. 22. I'm going to go, you know what? Actually, that was a little bit higher than I thought. So I'm actually going to go 2290, kind of right at that area. And I'm going to look at the trade tab, and we're going to go to 2290, right? 2290 is actually pretty far up this chain. So there's that 2290. So that's got to see a pretty good move. Now, remember, we've got $10 wide increments here. So we're bringing in a fair amount. We may even bring that down a little bit so that we don't need to see quite as much directional move in the trade. But let's start putting it together here where I think that target is, which is where I think the index is going to go to. So we're going to go to the 2290, and I'm going to start by selling that 2290 put option, and it's going to be pretty expensive. I mean, we're going to bring in, $55 roughly for selling that one. Now, what we're going to do is I'm going to go back out a little bit. We're going to come back out, close that one down. We know that that's the one that we're creating here is 2 days to go until expiration. And, here's the thing. Within the expected range of movement, we can get down to that 2290, right? That's within that expected range of movement. So now I'm going to come out, and I'm going to go a little bit further out. I'm actually going to go out to the 30 July, so a week from now. And I'm going to go, actually, you know what? I'm going to go a little bit shorter. I'm going to go to this one because it's got a little bit lower implied volatility, the 29 July, which is, to be fair, before the Fed meeting, right? So I'm going to go to that one, and we're going to go to the same strike, the 2290, and we're going to buy the 2290. So in relative terms, this is we're selling the shorter dated put option, we're buying the longer dated put option, and we're expecting directional price movement to that particular level. Now, because this index is fairly large, this is going to be relatively expensive. If we were doing this perhaps on the XND, which, to be fair, has some liquidity issues, this is going to be a little bit less expensive. But if we were to look at this right now, the cost of this trade is the cost that we're paying for. The max theoretical loss in the trade is what we're paying for, the 34.85. Max gain is unknown at this point because we don't know if we're going to roll it. We don't know if we're going to get a volatility spike. But what I want to do here really quickly is I want to right click and I want to send this to the Analyze tab so that we can look at it. And I want to take that iron condor off. And so here's our calendar spread. And this is the characteristic shape of that iron condor, right? Yeah, and Kelly asks a great question. Kelly asks the I think appropriate question here, which is it better to use puts for a calendar spread if you expect a downward move? Yeah, so if you're expecting a downward move in whatever the instrument is, you might use put options. If you're expecting an upward move as you put a calendar together, you might use call options. So this is going to be a long put calendar spread. And the expectation is a move to this 2290 strike. So if I put my cursor on that 2290 level right here, and I'm just going to make 2290, that's where we're going to get our maximum theoretical gain in the trade. And I can hover my cursor over that, and I'm going to say, hey, look, our maximum theoretical gain in this trade is fairly substantial. I don't know exactly what it's going to be because I don't currently know what implied volatility is going to do, but we can model that. So I'm going to look at our price slices here. And you see that I've got, if we take out this slice right there, and here's just our at the money price slice, or our target price slice, right? It is fairly directionally sensitive, which means that it requires some directional movement. It requires, to get to that maximum gain, some downward move, right? But, look at this theta component, right? As this is moving, this is going to be theta positive because that short option is going to be decaying away pretty quickly. That's working in our favor. This has got a pretty healthy theta positive scenario and a pretty healthy Vega positive scenario. So if we were to adjust some of these variables here, right? If we were to open this up and we were to adjust some of the variables, let's see if we can reset that. And now we're right on that level. And whoops, let's close that price. Oops, let's do this. We're going to close this down. And we're going to adjust these variables. Hang on. There we go. I'm sorry, the gear icon. I wasn't seeing the gear icon there. So I'm going to leave that price slice open. And I want you to watch that Vega number here. And you can already see that implied volatility is rising just a little bit here. But if we were to adjust implied volatility up, let's say implied volatility were to rise a little bit, you can see the impact to that P&L on the trade if implied volatility rises. And it also increases that Vega sensitivity. But you can see that implied volatility rise really has a pretty significant impact on the price of this option. And we're buying it. We want to be able to sell it for more when it's more expensive. So let's do this. Let's model the price going to our 23,900, right? 23,900. That's where we expect it to go. I'm sorry, 22. Sorry. That would be a big move to the opposite direction, 22,900. And we can see now what that potential gain, if we see a little bit of a rise in implied volatility, maybe 4% rise in implied volatility, we can see what that impact would be to our profit and loss in the trade. You can also see how it changes the shape of this curve a little bit. It brings that down, it widens it out. So that rise in implied volatility kind of changes the shape of this target. Now, here's the thing. In order to get max theoretical gain in this trade, at expiration, this has got to be right at that point, right? That's a fairly narrow target in this particular case. So what we're going to look at doing is we're going to look at taking this trade off when it's done maybe 25 to 50% of the gain that it can make for us, right? 2290 is where I'm targeting. 22,900 is where I'm targeting that move, right? So what we're going to do in terms of putting this trade on and then taking the trade off is I'm going to say, look, if we can get, look, doubling this, this cost of the trade would be 100% gain in the trade, right? So if I can get 25% of that, so you know what I'm going to do in putting this trade on, we're going to come back down to our, let me kill my annotation. That's what we've got going on here. Again, the risk in this trade, to be fair, is what we pay for it, theoretically. But remember, we don't have that early assignment risk, so we don't have to worry about that. And this is going to be over a couple of days, right? So we need to see some movement. It needs to happen fast. Implied volatility needs to rise. So if we bring this back up, and there's our 34.70, that's what we're paying for it. And what I'm going to do is I'm going to come back over here to my calculator. I'm going to say, all right, 34.70 divided by 4 is going to give me 867. So if we get 34.70 plus 867, that's 25% gain in the trade. And so if I can close this trade down, so what I'm going to do is I'm going to change this from single order to first trigger sequential, and I'm going to make an opposite order. So I'm going to create an opposite order, and an opposite order is the order to buy this, or excuse me, to sell this spread, this calendar spread. And if we can sell it for 43.37 or better, cool. We just made 25% on this over 2 days. Now, no guarantee, right? So 43.37 is what we're going to look at as our target to get out of this. So 43.37, and we're going to make that good till canceled. Now, here's the thing. If we get to 2 days from now, right, and the short leg is out of the money, guess what's going to happen? It's going to expire worthless. We're going to have the long leg in place. That long leg is going to be there and still potentially has some intrinsic value. Well, it doesn't have any intrinsic value because it would still be out of the money as well. But it has a longer duration. So we could sell another short leg against that, or we could turn it into a diagonal. But in this particular case, this is what we're looking to do. Buy the calendar spread as a whole, and then sell the calendar spread if it has done this 25% work that it can do for us, right? Now, you could use, Leon, a double calendar. Sure, I want to keep this simple at the moment as we go through this. And then we can start to layer in some of those additional ideas. But I'm going to go ahead and I'm going to click on confirm and send. So the order to put this trade on, we're going to buy this, and the order to take the trade off, we're going to sell it if it goes up. And if we get a spike in implied volatility, we could get out of that trade pretty quickly, right? So if the VIX spikes, or if this NDX index moves down and we get that pop in the price of the long option, then that's going to potentially take us out of that trade. So I'm going to click on confirm and send. We're going to read through this order and recognizing, yeah, this is an expensive trade. Calendar spreads, again, these are going to be relatively low cost to enter. They're also very relatively low probability trades. But this is an expensive index numerically, so this is going to be a little bit more expensive trade. And we're going to put this in our index options group, and we're going to go ahead and send that order off. And fire that order off. Now, we got it for $34.90. We paid a little bit more for it, and that can happen, right? So in those circumstances, that is a potential, right? Now, you could, actually, Kelly asks a great question. Could you roll this and turn it into a little bit longer, into a diagonal? Yeah, I did this in a shorter term time frame specifically for that purpose of recognizing that we can trade this in a short term time frame. You can make this a longer term calendar spread as well. But that's what we're looking for, is downward movement on the index and a rise in implied volatility. Both circumstances that, based on what we're looking at on the chart, could potentially happen here. Not a guarantee by any means, but could potentially happen. So that's kind of what we're structuring this trade into doing in this case. All right. Let's take a look at a couple of the other positions that we've got on here as we manage these. There's our VIX trade. I want to make sure that we get to our 14.7. So let's do that right now. And this is one of those circumstances. If you've been watching this webcast for a while, you know what we do is we sell a short vertical spread on the SPX at 14 days to go until expiration. We take it off at 7 days to go until expiration, come what may. So this one, we're at 7 days. We sold it for $3.80, right? And it is now trading for 15 cents, half step sideways. Journey asks a great question. If these are low probability and more expensive, low probability, yes, not no probability, number one. Number two, more expensive because it's an index, but on an equity, it may be less expensive than, say, for instance, diagonal spread or vertical spread. But the catalyst for doing a calendar spread is relatively low cost to enter the trade, to have some directional potential, and to capture a rise in implied volatility. So, Journey, those are the reasons for doing the trade. That's the catalyst for it. Low implied volatility, potential move to the downside. That's why we did that calendar spread on the NDX. But here's what we've got. Look, this has done the majority of the work that it can do for us. $3.80, and we're going to capture all but 15 cents of it. So I'm going to close this down, and I'm just going to simply create a closing order. We're going to buy this back for 15 cents or thereabouts. And we're going to click on confirm and send, read through this order, make sure that it is to close, make sure that there are no alerts that we need to pay attention to. All right. So there we go. We closed that down for 15 cents. Now we're going to go to 14 days to go until expiration. That's the 6th of August. And we're going to go to our chart. We're going to change our grid to our index grid, our index options grid. That's right here. The link to this grid is in the description for the web for this webcast. We're still above the 200 period moving average, which means we're still selling put spreads. If this goes below the 200 period moving average, then we're selling call spreads and we are bearish. Still selling put spreads, we are still bullish in this case. Now, that was our time hack from last week. So I'm going to delete that one. And I'm going to grab another time hack. And we're going to say, all right, we want to go out to the 6th of August. And we want to put a time hack on the 6th of August. That's right there. And where is now our cross of that time hack and our one standard deviation probability curve? And it occurs right there at 61. I'm going to call that 6140 for easy math, 6140. And you notice what's happening is volatility has gone down. These have gotten closer. Those lines, those crossing lines have gotten closer to the price of the index. That's the nature of lower implied volatility, where that one standard deviation range is narrowing down a little bit. All right, so let's go to the trade tab. We're going to go out to the 6th of August. We've got 50 strikes here. I don't think we're going to get to 6140. That's where it was, right? 6140. I don't think we're going to get to 6140 with only 50 strikes showing, so we might have to go out to 100. 6140 is right here, and that's about the 15-cent delta. So about 15% probability this is going to end up in the money at expiration. And so this is, again, a high probability trade, but it's not going to be necessarily a big winner. So we've been making these 20 points wide. So we're going to go to the 6140, sell the 6140, and we're going to buy the 6120. We've been making these 20 points wide for the purpose of potentially increasing our credit. Now, last week we got $3.80. We got lucky. Today we're getting $2.10, $2.05, thereabouts. Implied volatility has shrunk. The celebration of that low implied volatility says that this is, we're not getting a lot of premium out of this. But at the same time, it's a high probability trade. So we're going to go ahead and we're going to put this on. And our expectation is that we're going to put this in our weekly options, that this is going to continue to move higher. The index is going to continue to move higher. And if it doesn't, our risk in the trade is $1,790 if it were to go all the way through that spread. Again, this is a European style index option, so we don't have early assignment risk on the short vertical spread. We're simply looking at this from the standpoint of taking as much of that premium and collecting it as we can and keeping it. And if not, if this makes a big move to the opposite direction, we know what our theoretical maximum loss is in this trade. It is managed. So we're going to click on send. We're going to fire that order off. And remember, we're going to take this trade off at 7 days. We're going to take this off next Wednesday, come what may. That has been our operating method for this particular trade. So I'm going to bump this a little bit. I'm going to open that up and say, look, we may not get, again, this is paper. It's often going to fill at the mid price. Your mileage may vary. in the real world. And so we're going to go ahead and click on send and fire that order off. We got it for $2. So we had to bump that a little bit, which is fine, right? Okay. So now we've got that spread on, and we can close that down. There's our 14 days to go. Oh, you know what it did? It actually ended up dropping down here into unallocated. Did it? Yep, it did. So I'm going to come down here. There it is. I'm going to right click. I'm going to move it to our group. Is when I put the trade readjustment in to try to bump it a little bit, I forgot to send it to this group right here, index options. And so there it is right there. There's our 14 days to go. We want that to get as cheap as possible, as quickly as possible, at least by next week. All right. Cool. One more thing I want to do here really quickly as we get into this discussion, or as we kind of finish up this discussion. We have an iron condor, essentially. Actually, I'm sorry. We're left now with 2 short vertical spreads on the MRUT, the Russell mini index, right? And this one is expiring today, right? We are in the money on this option. So on this particular spread. So let's go to the trade tab for MRUT, right? And we had sold the call spread. Let's kind of scroll back down here. We sold the call spread and we've gotten plowed over, right? Was that a long call spread or a short call spread? Right click, create closing order, buy back. It was a short call spread. So we've gotten kind of plowed over here in this particular case. We sold it for 83 cents. We could potentially take maximum theoretical loss in this trade because it's deep in the money. Or we could roll this. Because remember, normally what would happen if we were this deep in the money on a short call spread on an American style option, very, very likely on expiration day, we would have been assigned early. But again, this is not an American style. This is a European style. So we're going to roll this out. I want to roll this out a week and just kind of give us some duration to see if maybe this comes back down a little bit. We may still get plowed over, but let's see if we can roll this. So I'm going to go back to the monitor tab. I'm going to right click and we're going to create a rolling order. Now, rolling, remember, is not a magic wand. Rolling is simply a convenience factor in being able to manage this trade, because all we're doing in this particular case is buying back one and selling another one, right? So we want to be able to sell this, and I want to be able to do this for a credit. So this by default rolls to the next expiration, which is tomorrow, right? So I want to roll this out a week. I want to roll out to the, let's roll out to the 30th of July. Right, which is next Wednesday. So let's roll this out to the 30th of July. And in this particular case, we're actually able to roll that, even though it's deep in the money, for a little bit. So a minus debit is in fact going to be a credit. So we're going to roll this out for a little bit of a credit. Theoretically. Now, rolling, the success of a roll depends on the liquidity of the target. Now, this is the SPX. So the MRUT. So these may be a little bit less liquid. But if this, this is still a fairly liquid index. So I'm going to go ahead and click on confirm and send. We're going to read through this order. We're going to accomplish this roll. And all we're doing is we're creating ourselves a little bit of duration, right? And we may need to bump that a little bit. So I'm going to go to our working orders. And in a vertical spread like this, if we're trying to roll this vertical spread, we may open that up a little bit. We say, look, we're willing to accept a little bit less credit in this particular case, and confirm and send, and put it in our index options and click on send, and we'll see if we can get that roll to accomplish. In practical application, rolling a vertical spread or rolling an iron condor, one that has multiple legs, may be a little bit difficult to accomplish. So you may think about rolling leg at a time as a possibility as well. That may be a little bit easier to accomplish, right? All right. So we'll see if that works for us. It may not. I'll keep an eye on that throughout the day. But look, if you want to learn a little bit more about calendar spreads, come on over here to Trader Talk's webcast page and type in the word calendar, And there you go. You got Brent Morris talking about the basics of calendars, calendar spreads on earnings. You've got Brent talking about them. Hidden power of put calendars ahead of earnings. Brent talking about calendars. Connie, me. You've got Cameron talking about calendar spreads. You've got me talking about 2 DTE. Oh, look, hey, we've done this before. 2 DTE long put calendars example on index options. I did that a couple of months ago. I didn't even realize that I did that a couple of months ago, but hey, that's good to talk about too. Again, so it's always good to refresh in current market conditions. But do me a favor, guys, click on the subscribe button here or click on the subscribe button down at the bottom of the page. So that you can follow us and stay connected to the Trader Talks webcast page. And follow us on X, at Ben Watson CS, at Cameron May CS. We'd love to have you over there as well. Guys, thanks very much for going on this little exploratory journey with me today in this discussion. I appreciate it. We will see you guys again here in this Index Options webcast next week. Take care. Bye-bye.